Good morning, ladies and gentlemen. Thank you for joining this webinar session with us. We at Inprism we are happy to take this session for our clients. I would like to introduce myself first. Most of the clients will know me. However, my name is Sudhendra Rao. I'm the founder and CEO at Inprism. Today in this session, I would like to cover up a few points. Especially for the equity investors to be successful. The markets are not at good levels. Markets have corrected. Tough times are going on, and I believe most of our generations have not seen such a tremendous lockdowns and not going out at all. So I believe it values to your knowledge. Let's start now. I would like to cover up initially what is happening in the market, what COVID-19 can change economically, psychologically, and across the globe, and how it's going to impact India. So then I will take the session forward. In the session, as I mentioned in the beginning, the markets are challenging, not because that COVID-19 is the only reason, because the whole world is suffering from this COVID-19 issue. This issue is raised from all you are aware that Wuhan, China. There are a couple of debates are happening. Let me not get into that. But what actually happened is that it has changed the way the whole world does the business. The whole world does the day-to-day activities. So which interim is the economical impact. So whatever we do on daily basis is actually the economical cycle. So for India, yes, there is a serious drawback because we are not a developed country financially. We are not a capital-rich country. We require capital from outside. So because of these uncertainties in the market, people of US, UK, people from European countries, people have pulled money from our stock markets. Because of that, the corrections have happened. But however, there's a very, very good news for you to conclude that in spite of such a massive withdrawal from the market, domestic investors like you and me and all investing into Indian markets, still our investment growth, around 8,500 crores has been invested by mutual fund industry last month. So which is still positive compared to the February month. So which concludes, that we are going to become a domestic-driven economy than a global-driven economy, and I would like to cover up a couple of points. How it is going to change the scenario in future, how it is going to be impacting the Indian economy. So if you take the COVID-19 issue, we know that our day-to-day activities have been stopped. So I think a couple of points we should know. Now it's a high time for us to consider additional passive income as one of the income for us, because most of people, there is a possibility of losing job. Okay, that's one negative point. And also we have to plan. Most of the business people has to plan, or maybe whole country has to plan for how we can come out of these circumstances currently, and come out of this maybe 6 to 8, 10 months it will take to come back to normalcy. And then the new industry, new trends will start. It will help India to grow. Followed by the very, 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 very big good news is that the Indian economy is going to attract more and more manufacturing industries. Okay, because as you are aware, most of the people, global people, are against China now. They believe it has been manufactured by them, but irrespective of the thought, but they are against China. So hence, we believe that be it Apple or be it Samsung, be it other big manufacturing companies may come to India, which is good for us. The only constraint is that the central government and state governments has to take a call how we can make them facilitate and execute it in India. The times to the further time taking to execute the transaction, easy of doing business. All these things will be should be taken care by government of India. Let us see how they take it forward. And with respect to mutual funds and stock market is concerned, yes, there is a big correction has happened because most of the people have withdrawn the money. So there is a panic selling is happening from US, European countries and all, because they themselves is not clear what is happening. So they want to keep the money out and keep it in their cash accounts and keep it in their bonds, treasury bonds, because they don't know what is the volatility. So we are also experiencing such a massive volatility. So I believe it takes some more time to come back, maybe a couple of quarters to settle down, and 2-3 quarters to come back to normalcy, and then the performance will come. Always remember that fundamentals of the companies have not changed. So that is very very important, because people typically think that when market crash happens, I would like to come out of the stock market. Nothing is happening in India, all those things. But fundamentals of the companies have not been changed. So fundamentals remain the same. Maruti Suzuki is still a strong company. HDFC Bank is still a strong company. Hindustan Unilever is still a strong company. Biocon is still a strong company. Infosys is still a strong company. Because of COVID-19, their business models have not changed. Yes, there is a travel restrictions have come. The travel industry will undergo a massive correction. Massive changes also, and it takes at least a couple of more years to come back to normalcy. I believe because of hygienic issues, people may not travel. So keeping these things in mind, that industry will suffer. Automobile industry, I personally believe there is a possibility that people will stop using shared cabs because of the social distancing is becoming part of the psychological thoughts of people. So I think there is a possibility that Maruti Suzuki is a beneficiary of that. And e-commerce business will do very well, because now people don't want to go out; they prefer to sit at home, and they've understood how to do. And I think people will take some more time to digest this lockdown. Followed by the lifestyle changes will happen. People will typically would like to upgrade their lifestyles. People would like to have refrigerators, would like to have televisions, so on and so forth. Maybe next 2.5 years, 2023 end, we expect around 390 million people, that is about 39 to 40 crore people, to become middle class in India, where they are going to be a good earning population. Their average age will be less than 30. So which is a beneficial for India. So meanwhile, as I mentioned in the beginning, if the Indian government or state governments take the initiatives today to welcome the manufacturing industry which are there abroad, will help the new upcoming people who are yet to get a job, for them to be a beneficial of this. Okay. With respect to what we should do now, sit down, relax. There is a turbulence in the flight, so just relax. If there is any necessities there, the people will give instructions. We are here to give instructions, and a lot of any necessary changes are necessary. We will let you know. And also, I would like to update you that if you have any amount of money now, please pump into the market. It will help you in multiplying the number, because the markets have already corrected. I don't think so anything further correction is expected. They are, even if it is expected, it will not meaningfully change the portfolio growth for next 2 to 3 years or 5 years from now. So typically as we always recommend, stick on to your goals. Have emergency funds intact. Have your retirement fund corpus building up. Have your children's education fund building up. Have your health insurance intact, and has your term insurance intact. And also some endowment plans which is necessary for interest rate risks which are happening in India. So we will now jump into the principles of successful investing. So nothing much I'm going to say. I think you would have already heard many times. People would have read about it, but I would like to give you the practical ways how you can implement this in your investment life, and you can become successful. So what is equity investing? So basically, equity investing, most of the people knows about. I'm just covering from basics. It's investing into a public listed companies. We have about 5,000 public listed companies in India. So which essentially amounts to being a part of a shareholder. For example, if you buy 2 shares of Infosys, you become a shareholder of the company. That means you are also a part of the business. So see, it's like outsourcing your money to a entrepreneur. So some is a good businessman who is doing his business very well. You take a share out of that company, then you are actually outsourced your money making to that CEO. So that's how it works. Always remember that buying a script. So not eventually that you're buying a sustainable competitive advantage business. Always ensure that you will buy a good quality business, not because of the price. So don't go and jump into stocks saying that Vodafone is available at 3 rupees. Some other stock is available at 2 rupees. Don't get in. If it is necessary, the price should not determine the fundamentals of the company. So always buy a good quality business. We always choose and recommend people to buy a good quality business. Of course, it is available cheaper cost. We call it as value investing. Consider investing into those kind of instruments which will help you to multiply your wealth very well. And also, I would like to tell, remember the financial institutions like banks, LIC, Life Insurance Corporation of India, EPFO, life insurance, insurance companies, other general insurance companies, or your life insurance companies, NBFCs, etc. also invest in equities. Most of people don't know that what are the money you keep it in SB account or what are the money you keep it in FD. Banks actually invest into the equities. If you take a recent example of SBI, what are the where they get the money from? So they have utilized your money and they invested into Yes Bank at 10 rupees per share. So now it's trading at 23 rupees. They've doubled their money. So even including banks, people do invest into stock market. Yeah, LIC, you keep listening from LIC because LIC is one of the biggest life insurance companies in the world in terms of number of policies is concerned, because they are a massive country. They also invest their 30-35% of their policy money into the stock market. They do make money and then transfer it to the investors. So do not think that I am the only investor investing in the stock market. No, you are all the financial institutions, including banks, LIC, also part of it. So that you are clear that you not only individual investors will invest, even people like big institutions also will invest in that. So I recommend you to follow these principles, which I have covered some, I think 8-10 points, which is very, very simple. I not try to use the jargons. I would like to keep it very, very simple. Instead of the points, I would like to, these points are only to explain. I would like to cover the in-depth and practical, executable models, which will help you to be a good investor. So if you are a first-time investor, start with blue chips. So blue chip is basically investing into top 100 companies in the country, which are typically substantially big companies, sustainable business models are there, market leaders in the market, in their own businesses, which will typically not have too much of volatility. So, or foreign institutional investors only invest into blue chip companies. They don't invest into any other companies. Now they start getting into mid caps and small caps. So don't ever worry about it. First, initially to start with blue chips, buy Axis Bank, HDFC Bank, Bajaj Finance, buy Infosys, buy SCL Technologies, buy so on and so forth companies, so that they have not too much of volatility. Anyway, there is a big discount series happening. A lot of companies have been corrected. I think you can make use of that opportunity. So these companies, as I mentioned, you have predictable earnings. You can predict their profitability, how they can do next quarter. And the cost of capital is high. If they invest 1 rupee in their business, they make 3 or 4 rupees out of that. That is very important. Long term, it is going to be a staying power. That means you have to invest into companies which will stay for 10 years. I would like to take small example. The photography business, which has been in the world from last 100 years. So where Kodak and Fuji are the two people who were the world market leaders about 15 years ago. So do you think they exist today? Both of them bankrupt because the business models did not change. So when people start utilizing the digital photography, people thought, how can somebody cannot take a printout of their photograph with a taken shot and they don't see and feel it. But today, the photography per capita, that is one person taking photograph is 20 photographs per person per year. So imagine the massive growth in the whole world, but the photography companies have been bankrupted. That means that we need a sustainable business model companies which stay for 100, 10, 15, 30, 40, 50 years so that your money is safe and you want to make money out of that. So blue chips will be the first key. Start investing from blue chips. So make a list, go to wherever in the internet you get, put top 100 companies in India, you get the list. Spend some time on that and you can take it forward. Always have a margin of safety. So I am asking you margin of safety. See, margin of safety is basically like driving a bike, wearing a helmet. It's a margin of safety. So of course, riding a bike is risky. That's why your insurance and other things are there. So, but necessary that you should think about what are the investment you are doing. You also protect your capital. So that I will cover how you can protect your capital in the future slides. So have margin of safety, which starts with your blue chip funds, and have a diversified portfolio will help you. So blue chip companies always gives you a margin of safety because the volatility is not too high. So you will be able to feel you will not feel too much of volatility in the blue chips. So which will help you. Always keep stop loss. I always tell most of the investors that do not think that all the companies are recover after the fall happens. So there's a small calculation which I will explain in the future slides that how if market fall by 50% to go back to to same price, it has to go back 100%. So if the stop loss is not there, so anytime when even we give a recommendation, we always tell you stop loss. When the stop loss is hit, you have to exit the stock. So which I will cover in the future. Start with the paper trade. So this is a practice I always practice in the beginning of my career. So what you should do is take a piece of paper, take a pen, open the market, think about which stock you want to buy to initially, make a note of the time, date, what time, what price, just mark it on the book. For example, Infosys is available at 600 rupees, you want to invest 60,000 rupees, you're going to get 100 stocks, just go and say today is 16th of April 2020 at 11:45 p.m. 600 rupees multiplied by 10 stocks, 6,000 rupees bought. So wait for the stock market to move however it wants, and once it becomes 700 rupees, maybe after 5 months or 6 months, you go and put an order saying that sold 10 stocks of 700 rupees, and it is executed. So this gives you a comfort zone how actually trades have been executed. So by doing a paper trade, your emotional impact will not be there, because when you put money, your emotional impact will come. So first you do the trade in the paper, which will help you. This is practically which I recommend. There's always a statement: be patient with the winning trades. Always, when you bought a stock at 10 rupees, if it becomes 15 rupees, buy some more. If it becomes 20, buy some more. If it becomes 25, buy some more. So be patient with the upside of the trades, and be erroneously impatient with the losing trades. So when it hits stop loss, you should exit. That means when there is for example, give a stock available at 10 rupees, the lower side is listed at 2 rupees. So if it becomes 8 rupees, you should exit. So it may come back. So sometimes it happens that it'll touch 7 rupees 50 paisa and come back to 11 rupees. Fine. So at least you'll protect your capital. All the money is not go for a toss. So and remember that it's quite possible to make large amount of investing, trading or investing money if you write only 30%. So if you take 100 trades, or you take 10 investment trades in a year, okay, even if your 3 trades are right, so you still make money. That I will tell you in the future how actually you can do. There's a profit to loss ratio that I will explain in detail there. So 30% of times you should be right, which is a layman can do it comfortably, keeping the step of being a investing in blue chips, because no volatility will be there. So have a discipline principles of investing. Discipline investment means have a clear cut mandate that how much money I can take risk cut. For example, if you have 100 rupees, if you're investing into stock market, be very clear. I can take 2 rupees loss, 3 rupees loss, 5 rupees loss per trade. Or if you're taking 10,000 rupees, 1,000 rupees my loss. If 1,000 rupees loss has happened, I will exit. So if you don't do that, I will tell you what will happen. The loss will pertain to 50,000 or 5,000. Out of, I take an example of 10,000, it will become 5,000. So that means your 50% of your capital is eroded. So then how will you make money? If there is a capital, there is a capital gain. If there is no capital, how will you have a capital gain? So these are the few steps to have a margin of safety. Keep it in mind that margin of safety is very, very important, because to take you be in the part of the journey. Because the problem with the stock market is people lose money and they get out of the business. So if you get out of the business, how will you ensure that you'll make money over a period of long term? So stock market, you have to be a part of the system. Time in the market is important than timing the market. So how will you have more time? For example, 2 months, 2 weeks, 3 weeks, 5 weeks, 10 weeks, then becoming 1 year, 2 year, 5 year, 10 year, I will be there. So I am in the business from last 10, 12 years in the stock market business. I'm still there because I follow margin of safety very, very seriously. We'll move forward. Don't panic sell or panic buy. This I always recommend a lot of people. People will become panic and sell. For example, a stock you have bought, fundamentally stock is very good, and the correction has happened on the stock by 25%, and you have kept 30% as a loss, stop loss. But 25% aa gaya, you got scared. 25% of the money is gone. You sold. Okay. Same way, assume some stock is you are thinking that the stock will do very well, and the stock has corrected by 25%. You want to just go and buy. Don't do both. So never buy any stock thinking that you're losing, you're losing upside potential. That means, if you don't buy today, it may come back. The market may, the stock may recover. Never do that. Have patience, and do not jump into any stock just because the price has been corrected. Have a reasonable expectation from investment. I always tell this. People want to double their money overnight. Nahi hota hai. It's not going to happen. Please make sure that you have reasonable expectation. I will tell you 15 to 16% of annualized return on a stock is a decent, beautiful return. So many fund managers struggle to do this. So be clear, 15 to 16% of the money if you make is going to be phenomenal. So try to be very reasonable expectation. If you're investing into a, not today you'll make more money because markets are already corrected, but over a period of long term, 3 to 5 years from now, if you are investing 100 rupees, make sure that you are expecting 15 16% return out of that portfolio over a period of 5 years. Because remember, now the FD rates on a SBI side for 5 years is 5.5%. So I'm talking about 10%, almost 3 times more return. That's a better expectation I am giving you. Having 10% expectation is good, well and good. However, 15-16% also is good. Some years will make more money. It's a bonus anyway. See, it's far better to buy a wonderful company at a fair price than a fair company with a wonderful price. So remember this. If instead of buying Yes Bank, which is at a cheap, it's very wonderful price is available, 24 rupees, than that you buy HDFC Bank at a fair price. HDFC Bank is available at 1000 rupees. So this means that do not invest because of stock price. A correction has happened. The stock was at 300 rupees. It's come to 30 rupees. 90% correction has happened. I want to put money. Don't do that. So it is very, very important for you to know that you want to invest only into the good quality businesses, even for short term also. Even if you're buying it for 1 month, 2 months, 3 months, still you ensure that the good quality business you have an idea. Always average your profits. That means I'm reiterating this one. I told you in the beginning also that when you buy a stock at 100 rupees, if it becomes 110, buy more. If it becomes 120, buy some more. If it becomes 150, buy some more. That's called averaging of your profits. Typically, what most investors do is they average their losses. Stock we bought 100 rupees, it becomes 90, they buy some more. It becomes 80, they buy some more. If it becomes 70, they buy some more. They become 60, they buy some more. So they don't never average your losses. So if the downtrend is there, just be there, be patient. Do not average your losses. Upside trade, you keep on averaging it out, and whenever you invest, last price should be the stop loss. For example, 100 rupees you bought, it become 110, you invested, keep 100 rupees as stop loss. So it become 120, invest money and make 110 rupees as stop loss. If it become 130, invest some more money and make 120 as stop loss. So it will have to happen. It's called marginally increasing your profitability, which is very helpful for you over a period of time. So do not panic buy or do not panic sell, and follow the instruction. Do not pick up any stock because it is corrected. Don't junk up your portfolio in the name of diversification. See, diversification means, we know Warren Buffett says, don't put all the egg in the same basket. We do understand. That doesn't mean that you buy 100 companies, or you buy 25 stocks, you buy 30 stocks in a portfolio. Yes, there is a possibility for mutual funds to buy it because it's massive money and managed by public's money, where they have to make sure that the safety is important. That's why they do diversification. It is not necessary, because to be diversified, you have to invest in a lot of stocks. You don't have to have 20, 30, 40 stocks in the portfolio. Having 2-3 stocks is good enough, or maybe 5 stocks good enough with a different industry. Buy one banking stock, buy one NBFC, buy one automobile company, buy one pharmaceutical company, and buy a hospital, or buy maybe some other industry company will help you, because all the companies will not go for a trend. And remember that these companies should be again quality companies, quality businesses which you understand. You should know the business. It will take some time. See, neither I became a CEO overnight, and most of you people also not become managers, senior managers, or people overnight. So it takes time for you to get used to it and get the execution done. So spend some time in the market. You will understand the trends. You will understand how actually it works, and you will take it forward. So they really like to a particular stock. Put 10% of the money and then on your portfolio. So do not buy because it's a good investment all the money. And also it says, make an idea to count. For example, you believe that Maruti Suzuki will or Sun Pharma will a good quality stock. Put 10% of your money first. Just don't put 10% of the money and sit alive. And if it is a good idea, if it is doing very well, then put good amount of money. Not because of you are thinking I will put 10% in 10 stocks. Not necessary. Focus on good investment strategy and stick to it. It will take some time. I have my own strategy which is difficult for you to implement. You will have some investment strategies difficult for me to implement. You will come up with your own investment strategy. It will take some time, maybe 6 months, 8 months, or 10 months. It will become easy for you to understand how actually market works, what is my profitability I should exit, what is my losses I should exit. You will understand. So you will come out with your model portfolio strategy which you follow, or else whatever the recommendations we give, stick onto it, and exit at the right profit and stop loss also, both the sides. Move on. Don't be afraid to hold cash. This is very, very, very important. Most of the people are always afraid to put all the money. I believe most of the customers, we always tell, can I invest it now? May bolte hai, no sir, hold on. Because we believe holding cash is very, very powerful. Because holding cash, if it's one more option for you to average, take an average of advantage of a volatility. If assume markets fall under 30% from now, or 20% from, we don't know, because that's a $1,000,000 question. If I know when the market will fall, I would definitely not in this business. So keeping those things in mind, we personally believe having little bit of cash is always recommended. If you have 100 rupees to invest in the stock market, always have 20, 30 rupees with you and only invest 70, 80%, which is good for you. The value of cash option rises the market when market volatility rises. So when the market volatility increases, so every day 2% fall, 3% up, 2% fall, it typically makes you to feel how exactly is this volatility will continue. It will help you. And then when the stock actually provides an opportunity to good companies to buy at bargain prices, you will have cash. You can get in and you can able to execute it. So on market, many market participants often neglect this important aspect of investing, and they always be safe, always fully invested. So if they think that if I want to invest 100 rupees, they always put all the money into stock market. If you observe our portfolios also in mutual funds or stocks, we do not put all the money at one shot. Yes, if you have a recurring income, then we invest because we will have going to get some more money in future. We make use of that as a cash. However, if it is a one-time investment, if you have, do not put all the money at the one shot to the stock market. Never be fully invested. Have a cash. It's a cushion for your portfolio. Treat investing and trading like a business. So this is very, very, very important, sir. People put order and they go for their work. It is not going to work like that. Or you have to leave it to you can outsource it to us. So we call you and say, sir, now the stock has reached this price. We can exit or we should not exit. Our partner angel broking will also give you some recommendations. They can outsource it to them. They will take care. So to be successful, you must have an approach of trading or investing as a part-time business. I know it's not a full-time business and not a hobby or a job. What will happen if it approaches as a hobby? There is no real commitment to learning. So when you want to learn something in the market to be rich, you will not have that unless if you take it as a hobby. If you have to take it as a business, and if it is a job, and then you will get frustrated because of no income. Because if you don't make money over a period of time, maybe 6 months, 8 months, you get frustrated, you'll get out of the business. So then if you get out of the business, then there's no meaning of making business at all. So be sure that you understand or take this business seriously as a part of your portion of business. Spend some time every day, possibly in the market, or maybe once in a week in the market will help you to do it. Trading, investing businesses incurs, remember this, it incurs expenses, losses, taxes, uncertainty of stress, risk. It is available in now my business also is available in everybody's business also in the job also. So if you think like this, as an equity investor, you are essentially a small business owner, and you must research and strategize the maximum of your business potential. You should know it will take some time. I'm not telling it's going to happen overnight. Be a part of the system for some time. Do take some trades. If you don't do the trades, you will not make money. Do some trades, and it will help you to make sure that the business model is, you're going to rise with some business model which will help you in executing it. Protect your investment capital. I reiterate this. I told you this in the beginning itself. Though ensure that you protect your investing capital. So if you have 1 lakh rupees to invest in stock market, do not invest all the money. Keep cash with you. Apart from that, please ensure that you do invest with a caution of margin of safety. Okay. So saving enough money to fund a trading account is a great effort, but doing it is very difficult to do it twice, thrice. For example, you want to put 1 lakh rupees today, you would have worked for it. After 1 month, you lost full 1 lakh. Pumping 1 more lakh is difficult. Assume you did it second time also. You think about if you're doing it third time, nahi hota hai. So that means you will lose the opportunity of multiplying your money because you lost the capital. I told you, I reiterated, losing capital means if you do not have a capital, there is no capital gain. So make sure that you have protecting your capital. It's important to note that the protecting your capital is not synonymously with never expecting losing a trade. That means do not think that because I'm protecting capital, I should not lose a trade. You will lose a trade. That's why the stop loss will come into picture. You will definitely lose the money in the stock market. So if you do not lose, that means you will never make money. So you should understand how you lose money, then automatically you make money. I'm sure most of our investors in mutual funds would have already felt it. Markets have corrected and recovered. If somebody is investors with us from last 4-5 years, it will definitely help you how we actually typically we have done it. Now don't make trading as a compulsory. Do not get into system because markets are open. Don't buy it. So if it is reasonable, good quality business, what all the parameters as per you or as per us, it is available, then only you buy. So buying and selling on a daily basis is not a good habit, and buying and selling on every week is also not a good habit. You should take a qualitative risk assessment trades, so which will typically should make you money over a period of time. And also investors have losing trades potential. Protecting capital can achieved by not taking unnecessary risks and doing everything you can to preserve your capital. See, just get into system, ensure that possibly what are the possible steps you can make sure that you will protect capital is important. Do not get into trades which is unnecessary. For example, markets have corrected 5% today. So let me take it tomorrow. Market will go up. How do you know? Or if the stock market is some stock has a bad news, you believe that the stock has corrected 20%. So let me get in now. So another 2-3 years the market will come. How do you know? So read it, understand the model, how it can be beneficial for your trade, and you should execute that. Always use a stop loss. I always keep telling this, and I want to reiterate this because most of the people always forget to keep stop loss. See, a stop loss is a predetermined amount of risk that you can willing to take or accept in each trade. So stop loss can be an amount or a percentage. If you want to take 1% stop loss or 100 rupees stop loss, depending upon you. But either way, it limits exposure during this. You will not lose a lot of money. Assume I have given a small example here only. In the future also, I'll tell you. You will not lose all the money. So if you have money, then you'll be able to execute you will be in the market for some more time so that you understand, you learn a lot of things out of the market. Using a stop loss can take some of the stress out of your trading since we know that how much money you're going to lose. So typical problem is emotionally people will take decision because the amount of money getting lost. For example, you invest 100 rupees, it becomes 25 rupees losses happened, you get stressed out. If it becomes 24, you feel okay. Then if it becomes 26, then you'll be more worried. Then you'll exit the trade. So those kind of decisions should not be taken. If you have a determined stop loss, I will tell you how to take a stop loss also in the next session, next slides, which will help you to take a stop session. And not having a stop loss is a bad practice. So you may be a successful trader, you may be a successful investor, you have never lost money, still do follow stop loss. I do personally follow stop loss very, very, very meaningfully. I never miss the stop loss to be put because I don't want to lose my capital. Even if it leads to a winning trade, even if you're making money. So I give you an example. Assume if you bought on stock at 100 rupees, assume it becomes 135 rupees. So your target is 150 rupees. So now you go and change your stop loss. Assume your stop loss is 80 rupees. So on the downside, if it becomes 80 rupees, I'll exit. On the upside, 150 rupees, I will exit. So then what you revise your stop loss from 80 rupees to 120 rupees now. So even if the stock comes down, 20 rupees will be in profit. So if it becomes 150 rupees, then you make your stop loss to 145. And continue to be in the tear. Be patient in the winning trades. It becomes 130, 140 rupees, 145 will exit. Assume if it becomes 160 rupees, then you increase your stop loss to 145, 155 rupees or 160 rupees. That's how you should keep on keeping stop loss, which is also beneficial for you to make money. The ideal is to exit all the trades with profit, but that is not realistic. Everybody, including me, come to stock market to make money only. Nobody has come to market to lose money. So it's not realistic. You will definitely lose money in some trades. Be realistic. Think that, okay, yes, trades will do lose money. I should be aware that if I don't keep stop loss, I will not exist in this business. So using a prospective stop loss that I told you will be limited to 8. So it takes some long time for you to lose all the capital, which will teach you a lot of lessons. What are the mistakes you did last time, which you can correct now. 2 is to profit to loss ratio. This is very, very important. Most of the times I keep reiterating to my clients. Whenever every 1% of loss of a trade you take, and you need to take 2% of profit. I will give you a small example. Assume you bought a stock at 100 rupees. You have kept 10 rupees as a stop loss. That means if the stock becomes 90 rupees, I will exit. That means then you should keep a target as 120 rupees. That's called 2 is to 1 ratio. This is a typically followed phenomenon across the globe by most of the successful traders and investors. If you invest into any stock, if you determine what is the stop loss amount or a percentage, it should be double should be the profit percentage. That means your success will be 50%. Even if 50% of your trades are successful, still you will not lose money. Let me take an example. If you 5 stocks you lost 10%. I'll take an example. 5 stock you lost. You bought a 100 rupee stock of 5 companies. All 5 companies you lost 10 rupees. Another 5 companies also 100 rupees you bought. They gave 20 rupees. So it gets nullified and your capital remains intact. So very good investors actually follow 4 is to 1. I will tell you people like Rakesh Jinwala, people like Vijay Kedia, people like Ramesh Damani, everybody follow 4 is to 1 ratio. They do trade now also, they do instead of investing. So every 10 rupees they lose in the trade, they make 40 rupees on the next trade. So that's how they make money. So that means 20% of their stocks are correct, still they make money. So initially started 2 is to 1, then move to 3 is to 1, then move to 4 is to 1, and then move to 5 is to 1. Remember, if you follow this strategy, to lose 90% of your capital, you need 100 trading sessions. Very, very important. It will not become most of the money. If you have 1 lakh rupees invested, assume you keep 1% as stop loss or 1,000 rupees as stop loss, it requires 100 trades to make 1 lakh to become zero. Every 1,000 rupees loss will happen. So 100 trades may, even if your 20% trades are right, still you will make money. So remember, protecting your capital, keeping stop loss is very, very important. If you follow this strategy, you will be very, very successful. You can start with 2 is to 1 and slowly move to 3 is to 1, 4 is to 1, etc. So it will come over a period of time. It doesn't happen overnight. So make sure that you are a part of the overall market. Be in the market, understand, learn from the market, and you'll be successful over a period of time. We'll move on. If you have any questions, I thought asking questions will also be helpful for you. Typical principles which I personally follow, which I want to tell you guys, which will definitely help you to be successful. So I think I will pause here, and I will happy to see the chart is open. If somebody is interested to put any questions, I'm happy to answer. Next, give us a couple of minutes. I have my iPad here, so I can see the questions if anything is there. So everybody has the chart available next to your WhatsApp screen. Please do post it. So I'll consolidate it for next 2 or 3 minutes, and then I will answer those questions. Thank you. ರಾಹುಲ್ ಅವರು ಒಂದು ಕಮೆಂಟ್ ಹಾಕಿದ್ದಾರೆ, ಕನ್ನಡದಲ್ಲಿ ಮಾತಾಡಿ ಅಂತ. ಸರ್, ನೆಕ್ಸ್ಟ್ ಟೈಮ್ ಸೆಷನ್ ನಾನು ಕನ್ನಡಕ್ಕೆ ಮಾಡ್ತೀನಿ. ಸೊ ದಿಸ್ ಸೆಷನ್ ವಾಸ್ ಬೀನ್ ಪ್ರಿಡಾಮಿನೆಂಟ್ ಡನ್ ಫಾರ್ ಇಂಗ್ಲಿಷ್. ಸೊ ನೆಕ್ಸ್ಟ್ ಟೈಮ್ ಸೆಷನ್ ನೀವು ಜಾಯ್ನ್ ಆಗಿ. ಸೊ ವಿಲ್ ಮೇಕ್ ಶೂರ್ ದಟ್ ಯು ವಿಲ್ ಗೆಟ್ ಎ ಕನ್ನಡ ಸೆಷನ್ ಫ್ರಮ್ ಮೀ. Looks like there's no questions. So what I will do is that whatever the questions you have, please drop me an email or inform my team. So I will cover those the typical topics in the next session. So hope this was very helpful for you. And I would like to thank you for being your valuable time with us. And I also would like to thank you for being our customer. So make sure that we will make sure that you are happy with us, and we will give you a right advice and make sure that you are going to be rich over a period of time. So be patient. There are a lot of corrections are happening in the market. We are intact with your goals. So we will ensure that you will be a part of your successful journey. And thank you so much. I'm signing off.